All right, today we're going to talk about the central bank. And the question is, does the central bank print money? Right? We always hear that. Now, it's important to remember that the central bank is what the name says it is. It's a bank. And as a bank, one of its main functions is that it can make loans, right? A loan is an asset for the central bank, just like it's an asset for a commercial bank. But there is also a liability that's created with the loan as well. The liability that's the reserves which the central bank deposits in the banking system. And the liability for a commercial bank, that's the deposit in the borrower's checking account. Now, the act of lending then is really a zero-sum situation. There's an asset that's created, right? And there's a liability of equal value on both sides, for the lender and for the borrower. And actually, the loan usually favors the lender because of the interest that the borrower pays, right? We have to pay interest on the loan. Now, central banks can not only lend, but they can also buy assets too. And their ability to buy assets using their own currency is pretty much unlimited, because there's nothing from stopping them from printing as much of those reserves as they want in order to purchase the assets. Now, this is where most people talk about money printing and central bank money printing, etc. But remember, when the central bank buys assets, while it's true it's giving the seller of those assets reserves or cash, it is also taking away from the seller whatever asset it just bought. That's usually a government security. It could be a bond, treasury note, sometimes gold, sometimes foreign currency. Most central banks do have the power to buy whatever they want. However, they pretty much only stick to financial assets, and within that realm, we're mainly talking about super high quality liquid assets like government securities, gold, or sometimes foreign exchange. Now, with these asset purchases, the public is not necessarily better off or richer. They get one asset in exchange for another, and the only time that it might really help is when the central bank buys low quality, non-performing assets, but that's very, very rare. It's like that's what it did when it bought the Bear Stearns portfolio, if you remember back in 2008 when the Fed did that. Usually it only buys the highest quality, most liquid assets, which are basically like cash equivalents. Now, you should also remember that if the central bank buys a government security that pays you interest and it gives you cash, all right, which pays very little or nothing, then it has taken away some of your income. You no longer get that interest income. So, it's hard to call that a stimulus. You're getting income removed. What the central bank cannot do is just give you money in exchange for nothing. It cannot just credit your bank account without getting something of equal or greater value in return. Now, the government can do that, but not the central bank. The government can write you a check, and that check is yours, and you can go cash it and spend the money as you wish. Now, some people might say, the government can't even do that because first it must take the money from us in the form of taxes in order to write that check. But that would be wrong. Governments that spend in their own currency, like the United States government, can run deficits, and those deficits are just adding to bank accounts in the aggregate. It doesn't have to collect those dollars first from us in order to spend. If it did, there never would be a deficit, and really on a much more basic level, no one would ever even have a dollar, right, if the government didn't spend those dollars into existence first. So if you're going to ask the question, if it's a question of which came first, the spending or the taxing, that's an easy question to answer. The spending always comes first. Anyway, that's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.